doing, everybody? This is Scott Kidd, the Yacht Captain Investor. I'm here with a good friend of mine, Bobby Sharma, interviewing him. He's with Connected Capital and been a fund manager for many years. How you doing today, Bobby?
Hey, good morning, Scott. Nice to see you, and thanks for having me on your. I love your podcast and everything you're doing to help real estate investors, all the yachties that you're helping. So yeah, thank you for having me on your podcast.
Well, thanks a lot, Bobby. I appreciate you taking the time to be here. Just for those that don't know you, just give us a quick intro of who you are and what you've been doing the last few years.
Yeah, so well, you and I are kind of neighbors. I'm a little bit south. I used to be a very active real estate investor. I'm a little bit older now, so I've slowed down and now focusing on building the Connected Capital community, which is a community made up of fund managers like yourself. And we do a deal review every week, but we'll dive into that later. But yeah, I'm sort of a semi-retired. Started out in California and Silicon Valley, doing small real estate deals, maybe starting 2010. But now, that portfolio grew, partnerships grew, and then I ended up in South Florida about 3.5 years ago. And, just now for about the last 1 year, still investing, still trying to find deals. It's a lot harder now. There's still some deals out there, but yeah, it's just building the community. You, me, and Eric have a community, and then I have Connected Capital, which is to help fund managers, high net worth individuals, the proper level of due diligence and deal review, underwriting. So yeah, that keeps me busy.
Yeah, it certainly does. I mean, if I may ask, what is the focus of Connected Capital? What kind of assets and businesses and stuff like that are you guys focusing on right now? Because things have been kind of topsy-turvy the last couple of years. So I'd just like to let the audience know what your focus is on so they can maybe take a look at what you're doing.
Yeah, absolutely, Scott. Yeah, like you said, the market has been a little bit unpredictable, a little bit. Well, there's definitely blood in the water in many markets. So the idea is to surround ourselves with other fund managers, take a more data-driven approach to underwriting and due diligence, reviewing deals collectively. Like every Friday we meet, we listen, we ask questions, and the idea is that maybe if you're like a lone warrior fund manager or investor, maybe you didn't ask all the questions that you should have asked, right? So the idea is that we do collectively ask the right questions. We dig deeper into the underwriting, the due diligence. We look at their financing, the market, the team, the growth. What are some of the challenges in those markets? And then only if everything seems to be checking out and we've done our due diligence, only then do we collectively, the fund managers inside the group, do we raise capital for those deals once everything's checked out. We have about 45 members right now, and we're constantly adding some new ones. But the idea is that the burden of underwriting and due diligence, which is a lot of number crunching, a lot of research, a lot of valid verification of data, reviewing the PPM, reviewing the contracts, the rent roll, all of that, once it checks out, only then do we give it a green light, and then the fund managers can go in and raise capital for that deal. So we kind of help fund managers and high net worth individuals with that approach.
So what would you say the advantage you guys have being together as a group going into, say, one asset or one particular deal?
Yeah, so mainly it's the group knowledge, right? A lot of these folks in our group are very experienced. They've been through multiple cycles. They can spot danger signs. It's kind of like navigating a yacht, right? If there's a thunderstorm looming ahead, you need to change your path to your destination. So our goal is to avoid the thunderstorms, the potholes in real estate investing, and maybe only proceed when everything seems to be checking out. So what matters? The deal itself, the market, the team, and then of course the capital stack. right? We have to make sure that the capital stack is right, that they're getting the right financing, that they're raising the right amount of equity, that they're giving their LPs the right kind of returns and not being, overly, greedy or anything like that. But yeah, that's the idea, is to make sure that collectively, through the lenses of multiple people, that the deal's still checking out, and only then do we move forward. That's kind of the benefit of working in a group. And we do most of the number crunching. They pay a membership fee, but we do all of the number crunching, due diligence, underwriting, most of it, about 80-90% of it.
And then there's also third party, correct? You guys also have a third party, which it definitely shows that there's power in numbers, and that more sets of eyes are going to see different experiences. So I think it's a great concept, and I think you guys are like on the beginning of a lot of other groups are going. I think a lot of other groups have tried to do this, but I don't think it's to the level that you all have done, because you guys' major focus is on due diligence, which, as we've seen in the last couple of years, the reason why some deals are falling out is because they didn't. I won't say they fudged the numbers, but they didn't anticipate that some of these other things were going to happen, and that the rates went up really high, and they were just caught out. What do you see going forward as far as over the next couple of years in say office and multifamily and in the industrial space going ahead?
Yeah, what we're counting on are great operators who are able to identify great deals. They're not paying retail. They're paying something. There's something special about the deal and the operator. And, there's multiple factors that go into that. But yeah, we still like value add multifamily. We like self-storage, mobile home park, triple net deals. We haven't received too many triple net deals, but they're coming. I'm starting to get inquiries about triple net stuff, industrial warehouses, strip malls, specialty strip malls, like auto, for example, just auto, specialized in auto, medical, about that.
Yes.
That's coming. But and we're now branching out beyond real estate. We're looking at businesses, and we're also looking at oil and gas. That's our next big one that we're going to focus on. But real estate stays at the core. But definitely working. It's working well. Great operators, great teams. So that's working fine.
Well, that sounds like there's just a lot of movement in the market. Each asset class seems to have a different take. With urban office seems to have hit some really strong headwinds. Just with all the COVID, and the COVID accelerator kind of slowed everything down there, and a lot of larger companies don't necessarily need as much office space, and you're seeing a lot of other businesses and assets affected by that. As far as over the next 2 years, what do you see as probably one of the better classes going forward?
Affordable housing is going to be still important. It's got some challenges. There is, in some areas, a housing shortage, not everywhere. If you look at the vacancy rates in many markets, the vacancy rates are very high. That, to me, indicates that there's not a huge housing shortage in those markets. We're seeing, 70% occupancy rates or 30% vacancy rates, whereas normally they would be at 85, 87, maybe up to 90. There are challenges. In certain markets, I do see a lot of overbuilding, which is going to bring prices down. It's going to bring rents down. But if the multifamily operator doesn't have his or her calculations done right, then those operators could be in trouble, because they were projecting, an increase in rent. But in many markets, there's no increase in rent. Florida faces some challenges. Texas faces some challenges.
Yes. Yeah, we've definitely seen some challenges here in Florida with the insurance increase and taxes increase, and with some areas having a lot of building. Texas especially, I know in Dallas, there's a lot of multifamily units especially coming online. So each area can be very specific as far as growth and stuff. And some of the secondary markets are doing much better than others, especially if you don't have some apartments coming online within 5 or 10 miles. And that kind of makes a big difference. So everything's very specific. But I know you've also been a fund manager for several years. What's your favorite type of fund that you like? What's your favorite one? Is it more debt-based or more equity-based?
Yeah, no, very good question. So I'm a very conservative investor, so I prefer debt, but I know that debt is low risk, medium reward, but then there's equity. Our goal is to go from high risk to medium risk, but high reward, right? So what do we do with the scrutiny that we put through all the operators through on Connected Capital is to take a deal, look at deals that are high risk, high reward, but after doing our due diligence, we want those deals to be in the medium risk but high reward. That's the alpha that we're looking for, right? And that comes down to did the operator buy it right? Is the team experienced? If the team runs into some headwinds, do they know how to get out of it? And then of course the market, right? The market itself needs to be just right. It's got to be a growing market. It's got to have some sort of a catalyst for income growth, job growth, and maybe gentrification, something like that. But those are the things that make it go from a high risk to a medium risk type of an investment.
Excellent.
That's what we seek in our group.
Well, it's definitely a very bright future with the group that you're putting together there, or you have put together. And this is only the beginning. So
Yeah.
I say that all the time with a lot of things, just because we're just getting started. And I really appreciate you taking the time to answer these questions and letting everybody know about what you're doing. If people want to find out more about Connected Capital and about you, Bobby Sharma, how do they get a hold of you?
Really easy. It's connectedcapital.fund, not .com. So you just make sure you put a .fund at the end of it. But my email is Bobby, BOBBY, at connectedcapital.fund. That's the best way to get hold of me. I'm on social media, just search for Bobby Sharma on LinkedIn or Facebook, but I'm there. Scott, we appreciate you being a member. I know you're going to do great things with your group, and looking forward to working much more closely with you going forward.
Oh, definitely. Like I said, we're just getting started, and I really appreciate your time and answering the questions. It's been really helpful for everyone. The Yacht Captain Investor out. Talk to you guys soon.
Thank you.
Bye-bye.